Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's going on. First of all, in the overnight session, the Italian government 10-year bond yield has continued to go up. Currently, the value is at 7.108 EUR. Sorry, let me just clear my voice up real quick. The bond yields are at around 7.11% for an Italian 10-year bond. Again, that's relatively negative and indicative of future bond depreciation, and yields continue to climb higher in the Eurozone. Again, this type of fear is being spread throughout the Eurozone primarily because of the declining tax revenue issues we're having out of Greece. Since the declining tax revenues are having a direct correlation with the cuts in spending on the government side, public sector job cuts equals tax revenues being shrunk. Tax revenues being shrunk means that the government has less money to pay off their current obligations. Therefore, the government has to continue to cut back on spending. The more they cut their spending, the less they get in tax revenues. The issue continues to compound upon itself, and therefore it's going to be a while before we can get a positive budget surplus in the Eurozone. But once we get a positive budget surplus, that's when things will start to turn around for the bond market. But until we get that type of signal in the bond market, chances are we're going to continue to deteriorate. We're going to continue to see bonds sold off, and we're going to continue to see the risk-off carry trade continue to play out as people take flight to safer or safe havens is what's going on. Let me just highlight a key point right here. The Euro-Japanese yen has continued going lower, and this is the main point. We had two consecutive closes right below the 101 area. We weren't able to get right above that 101 area, and then we continued downwards all the way into the 99.84 area. Again, I am very bullish the Japanese yen, and I believe the Euro-Japanese yen will continue this downwards trend. And therefore, if I was a bank, okay, if I was a European bank, and if I was a European financial institution, and I had hundreds of millions of dollars to reallocate, where would I put my money? Well, I would put my money inside of the Japanese treasury market. I'd earn a nice little treasury yield, the bonds are appreciating, and best of all, I get currency appreciation. So it's a three-way winning street if you're a European bank. And let's be honest here, in an environment where people are continuing to lose money, a real bond investor would know better than to hold their investments in European bonds, but rather a real expert in asset management would take their money, they would do the safe haven trade, they'd get yields, they would get currency appreciation, they would do everything in their power to make money. And that's exactly the trade we're seeing play out. And I believe this will continue to do so for quite a while in the near-term future. Let's go back to the Dow Jones Industrial Average. Dow Jones Industrial Average seems to be trading in a sideways pattern. Interesting point, though, is that we had a bearish engulfing pattern where we were able to engulf two previous candles, but the bullish engulfing pattern wasn't able to engulf the previous bear candle. And then we're continuing to go lower. Main reason why we're having a weak rally today is because, again, Dow component stocks are continuing to be bid up. Main reason why stocks haven't fallen too bad on the Dow component is because, again, Dow component stocks are pretty strong. I mean, people are trying to do sector rotation. They're trying to get out of the higher beta plays. They're going to the lower beta non-cyclical assets that won't depreciate as much inside of a recessionary environment. And what we're seeing on the Dow Jones Industrial Average is that the Dow Jones Industrial Average is pulling back just a little bit, mainly because the laggards are being cut, and they're trying to allocate companies or their assets back into the blue chip arena. Now, that being the case, how much lower do I think the Dow Jones Industrial Average will continue to decline? Well, I believe the Dow Jones Industrial Average will eventually come back down to around 10,600. But for right now, I believe the markets will trade relatively flat to slightly positive into the year-end close. The main reason why I anticipate this is because, again, asset managers want to close the year out on a positive note, slightly flat to slightly positive for all of those hedge funds that were heavily exposed to banking assets, or those who have cut back their bond positions. Those will be the institutions that will have negative performance anyway. But for those institutions or those banking for those hedge funds and those mutual funds that were closely following the S&P 500 or the Dow component, chances are they're going to close the year out positive, slightly positive, and somewhat flat, but certainly not in the negative or not in the red. And that's exactly what they're trying to go for. But again, quarter one, quarter two, 2012 is where I really see these markets taking a nosedive, until the Italians, the Europeans, the Grecians, all the the Irish, the Spanish once they get their house in order, their financial house in order, that's going to take quite a while, and the longer we see budget deficits, the more likely it is the economy will continue to contract in the Eurozone. So again, that does it for the Eurozone. Let's go ahead and analyze the next chart, which is going to be the silver chart. Again, I got kicked out of the trade. I saw us hitting that 26 area. We were bouncing off it immediately. I noticed that we had a nice little bottoming star pattern right there, and I just couldn't help but close my silver position yesterday. Good thing I did. The AGQ went up even further on today's trading session, so I did abate some losses right there. I actually closed my trade out slightly in the green, so it wasn't too bad of a trading position for me to take upon myself. But again, my silver position kind of got crushed. Again, I wasn't really anticipating 26 to be a really strong support area, but it turns out I was wrong. And obviously I had to cut my losses just like everybody else does on Wall Street. So again, I lost around 0.5% for my portfolio. Not too bad. Good risk management does take you very far when you're trading markets. Now, in all lights and in all consideration, I do believe the dollar index is still on a very strong upwards trend. Right here, we are running into that 20-day moving average. It's continuing to trend upwards, this 20-day moving average. So keep that in note. When a 20-day moving average is trending upwards, it gives the markets a lot of support, and it continues to bounce off of it as it continues its upwards trend. This is just typical technical analysis. This is just typical market behavior. Again, the dollar index is continuing to be bid up, mainly because of the fact that European investors are continuing to flee out of European assets, and they're trying to buy into safe havens. One of them is the Singapore Treasury market. The other one is the Japanese Treasury market. Another one is the Swiss Treasury market, and then the final one is the U.S. Treasury market. Now, the ones that have the most scale and the largest ones are really the U.S. and the Japanese Treasury market. So that's why we're getting a nice little bid up on the Euro-US dollar, or more like we're seeing a decline on the Euro-US dollar and the Euro-Japanese yen. Moving on, let's go ahead and talk about the gold chart. Gold chart is also having a nice little bounce right here. Again, it kind of mirrors the pattern that we saw in silver and gold. You guys notice that it mirrors the pattern, except silver was the first to react and snap back up off a really nice support area. But gold didn't really have a specific support area in mind, except for this one right here, where it crashed all the way down a bit. It kind of chopped through there, but then it came right back up. Again, I wasn't too convinced on the gold chart or the silver chart. That's why I had to cover my short positions. Took a 0.5% loss to my portfolio. It's definitely okay. Typical market behavior. Not everybody gets to win. Okay. Now, gold position did have a nice little pullback right here. It pulled right beneath that. It did go right above that. And I want you guys to notice something real quick. US dollar index has a pretty nice 2-day decline. And you're noticing the silver and gold has managed to abate their losses and have had a 2-day incline. So you're having an incline in the gold market for 2 consecutive trading sessions, and then you're having a decline in the dollar index for 2 consecutive trading sessions. Again, this kind of plays out to a bear flag pattern in my opinion. But again, this bear flag pattern could take a while to play out, but it could be a very minimal pattern. What it could end up being is an A pattern instead. And again, A patterns are relatively negative. I really believe that we're still in a downwards trend, and it's a downwards trending cycle. Remember, the silver market is directly tied to the dollar market in the silver spot and the gold spot. Remember, it says XAG, which is the symbol for silver, and then USD, which is the dollar. Okay, so right now, if you see a nice little incline in the dollar market, chances are silver and gold are going to pull back, and that's because they're directly paired to the dollar. They're pegged to the dollar, and therefore any currency appreciation on the dollar side would imply devaluation on the gold and silver side. And based on the technicals we're seeing out of gold and silver, it's not surprising to see people continue to sell as we are in a downwards trend. Okay, moving on, let's go ahead and analyze the Amazon chart. Amazon has had a pretty nice decline, but it was able to bounce off that 168, 164 area pretty nicely, 160, 168, somewhere around there. Again, I saw that gap area, but I did want to stay a little patient. I wanted to hold on to the trade. I did want to see further moves to the downside before I eventually close at 160. So 162, 161 is my target exit zone for the Amazon short trade. After it gets to 162, I anticipate a pretty modest bounce before we continue to head lower into the 140 or perhaps the 120 area. Again, let's go ahead and pull back the chart real quick, and we'll go ahead and plug in some Fibonacci retracement points right here, Fibonacci. And right now, since you don't have a whole lot of areas to determine, sometimes it's better to use Fibonacci, and there you see it. 143 is a good area. Once we get a nice little bounce off the 160 area, this is where I really want to just close my position at 162. I'm probably going to anticipate a small bounce. If not, we'll probably flush straight through 160, and chances are we'll run into around 143 at the 50% Fibonacci retracement area. Now, again, you usually use Fibonacci areas where you're trying to determine other areas of support or resistance. In this case, this is a major Fibonacci area, and therefore I could reliably use this as a means of anticipating a potential area for support. Again, let me just draw this in a little more accurately again. And again, it's even clearer now at 141.45. So anywhere around there could be another target exit zone, but in my case, I want to close out at around 162, take my profits off the major support area back made in the middle of March, probably get a nice little bounce, maybe 1 or 2 day bounce. We probably close right below 160. We break below 160. I reinitiate a short position, and then I cover at around 141.45. So that's, again, my trading strategy on the Amazon chart. I anticipate this downwards trend to continue. Again, Amazon's revenues aren't enough or stellar enough to warrant such a high price to earnings ratio. Let's also consider their net income has continued to drop, their margins are dropping, the amount of money they have to invest into their operations so they can get more revenue has turned out to lose them a lot in operating margin, and that's not a very winning business model. And again, $30 billion in revenues versus Walmart's $200 billion, $300, $400 billion in revenue, and there's a huge spread between what's realistic and what's not realistic. Amazon was trading at a $100 billion market capitalization, whereas Walmart was trading at a $200 billion market capitalization. But the only issue was that Amazon had revenues of only 10% of what Walmart was making. Visa is on a continued upwards trend. Again, this is just strength in the markets. If you want to be exposed to financial companies and consumer services, Visa is the way to do it. I am still long Visa. Moving on, Direction Daily Financials. This should be in a continued downwards move. I don't anticipate much more upside in the financial markets. Therefore, I would be bearish to FAS. That does it for me for today, guys. If you have any questions, leave a comment right below.